This is Block and Bell, where crypto meets Wall Street. Every week, we break down what's really moving the global markets, from Bitcoin and digital assets, stocks, gold and silver, to institutional capital flows. If you care about where money is going next, you're in the right place. Let's get started.
Welcome to the Block and Bell podcast. I'm Rex, and this is Anna. And today we have a very interesting content talking about yield farming. What is yield farming? How do we generate money in a safe manner without, succumbing to certain risks? If you'd like to present yourself, Sasha and Tyler.
Yeah, sounds good. My name's Tyler. I'm a co-founder of Splyce Finance. It's going to be a protocol that's launching on Stellar, Solana, Sui, and then shortly after EVMs. And essentially what we do is we do institutional fixed term lending. So this is where we pair institutional borrowers who have collateral that could either be crypto assets, or we have a large focus on tokenized securities and tokenized permissionless RWAs. And we pair them with lenders who basically fund that liquidity or fund the loan for the borrower. And what that lender gets is permissionless yield. So anyone with a stable coin can come deposit and start earning permissionless yield and get back tokens that are freely usable across DeFi. I've been in crypto quite a long time, guys. So goes back to, I think, 2012 era, was just an early finder of Bitcoin, and then got a chance to test and work on Ripple's first DEX. In 2012, was about 4 years before the first EVM DEX, and then was hooked. I worked in tradfi in the ETF business, was lucky enough to build the digital asset team at S&P Indices, where we did some of the first crypto ETFs and the first tokenized indexes. This is back in like the 2020 era or pre-2020 era, and was sold on tokenization. So became head of digital assets at Securrency. I continue to do some of the first tokenized funds with major US banks and asset managers. Before we sold that business to DTCC. And that is when we spun out and started Splyce.
Wow, amazing. It sounds like you've seen Ripple before it was existing. Where was your first Ripple you bought? Like half a penny or something?
It was free because of testing their platform, but you would have to go out 3 zeros, I think, before I, when I made the first actual purchase on my own, 3 zeros were in front of it. I don't remember what the other were.
That's impressive. Yeah, and I remember Ripple used to just rip to $3 or whatever from nothing. There was thousands of percent.
Yep.
So many.
The good old days, right?
Yeah. All right, Akash.
Hey everyone. Quickly about me, I started with Bitcoin in 2014, specifically arbitrage trading between the Asian and the European market. It was quite a time where you had large inefficiencies across these markets, and there was tremendous opportunities back then. So that's how I got into this. Then, being a techie myself, I kind of get into the enterprise blockchain tech. I started a company which provided, some of these, built some of these GovTech and InsurTech services on the blockchain. That company got acquired in 2019 by one of the largest Asia's GovTech firm. And ever since then, I have been into DeFi. Last 5-6 years, I worked with some of these large crypto banks such as Cash Out for their treasury and portfolio management. I led their portfolio team for 3 years, ranging roughly $500 million to $1 billion in assets back in 2021 to hype market. So that's what the background I came from. Very recently, I started Alpend. Alpend is a privacy-preserving money market. Think of something like Aave, but built with a focus of private transactions. The core thesis we have is that the lending or the money markets like Aave is a very good concept. However, they lack in with some of these execution problems, such as getting liquidation targeting, getting into MEV, things like this. So that's how we started working on Alpend, where we built this protocol which designed around deterministic execution and ensure that how we control the flow of information by growing the premise that if something happens in DeFi or if something happens in lending market, then we should not just publicly broadcast it, but ensure that who needs to see what in order to keep the entire transaction sane is what we do. And that's the premise in which we are building this credit market, Alpend.
Wow. Yeah. No, it sounds very complicated. I'm sure there's a lot of use cases, but you definitely have to be deep into DeFi and understand how to do these arbitrage strategies and use Alpend. But I'm sure it's a great product. It sounds like you're doing great things with it. So that's awesome. Anyway, let's get to the questions. So defining yield across systems, like how do you personally define what yield is, right? And what's the difference of yielding between traditional finance and DeFi?
I think it's a great topic because, at least from my viewpoint, coming from tradfi, there's natural crossover with DeFi yield. And I think we're really just starting to see this sort of transition start to happen, right? From like yield farming and incentives-based yield to actual yield that's backed by real world assets or traditional financial products. I think that's like the big distinction you're looking for is in finance, yield is coming from actual economic activity that's happening through various financial institutions, various product structures. And DeFi largely up until now was based on incentives or some type of tokenomic structure that spit out yield, but this wasn't really sustainable. We've seen a lot of volatility and compression in the yield space to date. And, specifically what we're trying to do with Splyce is bring more resilient yields that are backed by actual institutions and backed by assets that those institutions hold. So yield that's technically produced off chain, we're moving on chain in a permissionless way. And, I think that's really like the watershed moment for this like institutional DeFi crossover.
Wow. So you're saying that basically instead of like buying stock in the stock market, you could just use crypto. So it's a different way of getting the yield, right? Essentially allowing the masses to get products that they couldn't get before, essentially.
Yeah, exactly. So, a lot of the yield that's been in traditional finance is pretty gate kept, right? And, you can go anything from like an APR on your checking account to products that are, maybe private credit products that most people, that aren't institutions or high net worth don't have access to. So, that's really our focus is moving these, off-chain instruments that are already producing yield and increasing access to really anyone who holds stable coins.
Yeah, makes sense. Akash, do you have anything to say about?
Yeah, I think to add in from what we think about yield, ultimately, at its very core, I think that yield is a share of productivity. You put capital into an economic system and earn based on the risk that you are taking. That's simply what, kind of yield should be. And I think, kind of this definition, whether, you're coming in from or we see it from the tradfi or the DeFi part of things, this doesn't really change the fundamental aspect of it. Definitely, in the case of DeFi, this starts to get divergent because the way yield can be generated. In tradfi, kind of the market has been matured enough. In DeFi, over the last few years, we have seen that there's these new sources of yield mainly around, let's say, token emissions or inflation, which is not necessarily directly tied to the productivity, but kind of the productivity or essentially the economic value driver here is the hype in the present scenario. And of course, this doesn't remain sustainable, but ultimately, thankfully, because of this same thing, I think over the last couple of years, we have started to see this shift, even in DeFi, that the yields are getting more and more tied to the productive, since tokens are not doing that well, right, in the last couple of years. So people have been naturally started to accept that they should be able to see this in a more or a similar environment how we look into the tradfi world, where we can really generate yield in those cases.
Yeah, wow. Yeah, that's really interesting. You're right. It looks like DeFi had its fun moment, and now people realize that if it's like 1,000% yield, there's probably a problem. The token is just going to drop, right? So it's good that we're coming to this realization and building real products like you two guys.
I think the highest yield that we saw during DeFi summer was like 47,000%.
Oh, yeah.
One of these like smaller protocols, which is
I think
just
it was Wonderville, right? Was it that one? You
I was talking about, I think it was Pickle Finance. But
oh, man. Oh, that one. that was fun. I mean, I think I yielded for a day, and then the token dropped just enough that I was like, okay, I made no money. I like doubled my tokens.
You know what it did though, man. Even if we're talking about like DeFi and this, I don't want to paint it in a negative light, like this DeFi summer or the early DeFi yields, because I feel like what it did was like create this super sophisticated class of users who are going to be onboarded to this next wave. That'll be an improvement. But it really got like the attention of the space, right? And onboarded a ton of people who are now using this type of stuff. So I think it's going to pay off in the end, but yeah, I think it was a unique event. I don't think we're going to see that again.
It's
Probably
sort of
not.
the DeFi bootstrapping, right? So
Yeah.
every industry has its bootstrapping moments.
For sure, for sure.
Exactly. Just like any new industry, right? It was a new way of doing things. It brought a lot of scams and stuff. It brought a lot of interesting tokenomics, but overall, the survivors will stay and the real projects will stay.
Akash, I have a question. In terms of the origin of yield, in DeFi, we have yield farming, and in traditional finance, we can deposit our money and also earn. So in traditional finance, yield is often tied to real economic activity. Where does the yield actually come from in DeFi?
So in case of either DeFi or, for example, tradfi, generally in traditional market, yield is tied, as you said, to the real economic activity that includes like lending, production, cash flow, things like that, the real economic activities. DeFi has a little bit of different sense of where the most of the yield currently comes in from. I mean, from the sustainable yield. A lot of sustainable yield in DeFi today comes from the trading activities, right? The leverage that people are taking, right? And then, of course, still a major part is the incentives in DeFi. I would say that these trading activities, the leverage, and the and these incentives create the largest one of these yield sources. Now, of course, the issue is that incentives often stimulate demand, that rather than kind of reflecting that really the product usage is required. So we end up with systems that look productive on the surface, but the yield is actually being subsidized rather than earned, and that doesn't lead to a very sustainable form. But of course, it is one of the major yield sources.
And why yields in DeFi, you can notice that it's really higher or even much higher than traditional finance. And what are the opportunities and risks there in DeFi? Also, can you share with us one of your most successful or the worst experience in yield farming?
Akash, I think you described it pretty well, especially when you're talking about like most DeFi yields. Look, there's like a ton of the incentive-based stuff still going on, but a lot is based on like trading behaviors. And I think this is actually like, that's going to be one of the major sort of catalysts for why this, I think, shifts more to like traditional financial products backing this yield, because variable rates, which is essentially what we're talking about, in DeFi, if it's based on economic activity on chain, compress. And we've seen those, compress quite a bit to the point where they're actually like on par or below US treasuries. So why would you go about yield farming DeFi yields if you can just put your money in something that is completely safe and earn the same amount? So I sort of see it like the next period is really going to be a crossover where we combine these yields together, where you're seeing sort of like on-chain activity, backed by these assets. But, that range is going to be much more, let's say, like responsible on the risk return curve. Like these targets should really be 5 to 10%. DeFi has this expectation where like, they want double-digit yields and no risk, but the frank answer is like that doesn't exist in the world, and you're getting paid yield because the risk is higher. So I'm really bullish on like combining sort of all these topics, maybe dropping incentives for the most part, and running with tradfi yields that are bolstered by on-chain activities.
Wow. Yeah, that's a great idea for sure. Like trying to understand where the incentives are not needed anymore to still bring activity.
Yeah.
It feels like you're
Exactly.
doing it perfectly,
Exactly.
Right.
And you've seen a couple big institutions, move into DeFi recently with big TVL numbers, and they're not like really running any incentives at all in terms of yield. Sure, there might be some like LP incentives on third-party protocols, but like people are coming for the yield that's 100% backed by tradfi activity, right? Like there's no incentives, and some of these folks are pulling in, hundreds of millions a quarter, if not in a week. So I think the shift is honestly like started already.
And the yield, is it still made with USDC or USDT, or would it the yield be in like some different token?
I mean, usually you're depositing, a stable coin, whether it's USDC or USDT, to get access to that yield. That's how I see it, persisting for the reasonable future. There definitely, I think there are some people working on, modifying that a little bit, but I think I'm a big fan of just attaching it to stable coins.
Yeah. I mean, you want stability, right? That's what it comes down to. I do have you heard of Stacks, STX, where you can yield Bitcoin? That was an interesting thing. But again, I mean, then you're just taking on risk.
I see over the last few years, we have seen a lot of these CDFI companies coming in, especially around Bitcoin LSTs, right? They have, kind of some of the what Tyler was mentioning, coming in, racking in over $1 billion in TVL, 500 mils in TVL. And most of these are the Bitcoins, kind of the companies who are already doing a CFI business where they providing leverage trading on Bitcoin and things like that. And they have tokenized that same assets, created that in the form of Bitcoin LSTs, right? Created an asset against which you can borrow against. So here you are providing in the systematic risk patterns, and then the new yield sources are coming in from, because people can now borrow against those assets. So some yield that is flowing back into that asset, and you're trying to create them. So I think some of them are good examples of people getting into the Bitcoin LSTs use cases as well.
Just for some of the audience, what is a LST? Just to make that clear.
LST essentially means the liquid staking token. So you at the very simple, you can say something like STETH. So ETH is your native token, right, in the Ethereum network. If you stake that to something like Lido, a liquid staking protocol, right, you get STETH in return. So and this STETH is kind of essentially accruing the validator yield that Ethereum generates. So you get STETH, you are accruing those yield from the token inflation, of the Ethereum network. So that's kind of so that's where we were discussing about these different kinds of yield, and this is like kind of an incentive. This is like an incentive yield provided by Ethereum network so that they can keep running the validator or provide their network securities.
I wanted to add on to what Akash was saying. You both mentioned Bitcoin yield, and we're talking to a few parties. Like Bitcoin really hasn't had access to yield yet, so this is like a huge space where exploring with a few different parties. But they're looking for permissionless yield without selling out of their Bitcoin, and this is obviously like a huge liquidity unlock for the lending space, like what we do at Splyce. But there seems to be, massive demand on the Bitcoin side for this type of thing, right? The other thing I wanted to mention too, I got out of, I won't name them, but I was in one of the larger crypto asset managers, and we're even talking about like creating structured products where we take yield from DeFi and tokenize that and package it into traditional ETFs and then pass that back to tradfi markets. Like, the space is definitely going to rapidly change, I think, over the next few years. And, people getting access to DeFi yields through traditional markets is, obviously a huge unlock. So looking forward to it.
Yeah, I'm sure that's going to bring a lot, that ETF. Of course, you get that little management fee, but you're still getting higher rates than, treasury bills, right? Because that's obviously the standard, most safe way to earn. But it seems like both of you are mentioning that there's a lot of institutional money pouring into crypto. How will that change the space for yields in general, do you think?
Yeah, I'm happy to jump. Splyce is really catered to institutional needs. We built it to be fixed term, fixed rate based on institutional LP feedback. The main feedback was essentially like a protocol like Morpho's not really, well set to handle institutional capital. I know they've done a great job at scaling, but when you have their pools are commingled, right? So if you have one collateral item that goes bad or one loan that goes bad, it causes a rate contagion. And the biggest issue for capital coming from the institutional side is they can't plan around variable rates. So it's been, DeFi in its current form, I think, has a couple really big barriers to institutional capital, but, people are out there actively solving them. And obviously they're dabbling in some of these larger protocols already, even though those issues persist. But I'd expect to see sort of like a maturing of that space, right? Like they're not going to want to see incentive driven yield models, and they're not going to want to see contagion risks. They're not going to want to see Oracle risk. It's really going to have to solve some of these like key problems, right? Before we see big flood of institutional money. Right now, you're seeing early adopters, no doubt, but I expect that to continue and protocols to sort of tweak themselves to more readily onboard that capital.
Understood.
Right. No, I think Tyler covered this, covered most of it. But just if I have to include in the same, we see that probably the early users have jumped in already, have given DeFi a kickstart, right? But in the kind of the nature, the way the DeFi was built in a fully permissionless or the open environment, the transparency which becomes the base, right? We have started seeing that as more and more institutions enter into the ecosystem, this is the kind of a structural problem that they have started realizing in. We saw a few months ago this hyper liquid whale hunting, right? I mean, people have been hunting that guy, right, to get them liquidated. So some of this creates a problem of, let's say, the extreme transparency. We at Alpha, we work with a number of institutional customers at Canton, including, just say, the likes of the Cumberland, GSR Ventures, and those of the market makers who are looking in from the leverage on the network. We operate on Canton, which kind of specialize as a blockchain technology for institutional use cases. And that's the kind of use cases we mostly talk about, where we see that these institutions, it's not about that whether they want to come into just DeFi or not, but it's about how much they are exposing and whether they can open that exposing, whether they can afford that exposure of their balance sheet or the kind of the strategies that they are taking, because it's very publicly broadcasted. So I'm seeing that most of these institutional users are coming in. They are also getting in with the kind of compliance that they want, right? Like, for example, we cannot just directly say that, okay, we just do a zero knowledge transfer of that particular transaction and put into a GK blockchain and get this problem solved, because many of these institutions not just need to verify that the yield has come, but their auditors or their compliance officers, they need to see some of these portion of the information where this yield is coming in from. So even when we talk about privacy, it's not a binary that either it can be fully open, right, everything to everyone, or the other extreme where it becomes so private that even the CEO of the company cannot access that data when they need to, and which becomes a problem for the institutions, right, given the guardrails that they are operating in. So we see that it becomes paramount that you build solutions that kinds of balances this. You kind of build on this open nature of DeFi, permissionless, but kind of ensures the guardrails that those who can see things need to see this, right, and solve the institutional problems. I mean, of course, I come from the privacy background, so I've been doubling down on more of these issues, but kind of I just wanted to highlight some of these issues or nature of current DeFi, due to which institutions are not fully able to adopt it. And those are the things some of those are things we need to change in to get in these guys to play with us.
Oh, yeah, that's fascinating. Honestly,
Yeah.
it sounds like institutions want to get in, but they want to make sure that there's compliance and everything. Because indeed, the yields and the what you can do in DeFi is maybe making them more than anywhere else they would put their capital in. So it's very interesting to see how the space is growing and allowing this compliance to happen.
Yeah.
Especially-
So here, in terms of being private and permissionless, and Tyler is more based in US and Ash is in India. So would you like to share with us perspectives from the regulation right now in DeFi? Also, as DeFi is permissionless, while traditional yield products are often restricted. So do you see this as a flaw? How do you see the vision for the DeFi in the regulation perspective?
Yeah, it's a good question. I've worked with like the SEC and the CFTC, both on education, but also to pass through some of the first tokenized, security frameworks. So quite familiar with how those folks operate. Specifically how we're going about abstracting yield on the Splyce side so we can make it permissionless is actually attaching it to basically loans, right? So in that way, you're able to offer it as a non-security to permissionless lenders. But, I think you're going to see, more traditional securities types products enter the DeFi space too. And there's, going to have to be some type of moment where we come up with a better solution than just like hard KYC. I know there's some teams working on this, like a softer touch entry point or something like that. But yeah, in general, I'm a fan of, freer, more open markets. I think a big opportunity, that we're going after along with other people is, bringing US products, and hence their yield to the broader international community. And, that's really only going to happen if we can figure out permissionless structures that work, right? Like there's a reason, half of the world is unbanked. It's because the current system doesn't work and doesn't onboard those people. So if it's not permissionless, we're not talking about increasing access for those folks.
Yeah, that's a great point, that it just allows everyone outside of the US to join these yield opportunities. Because indeed, when I visited Lebanon, everyone was just using stable coins. They can't use their Lebanese lira. It was like,
yep.
It's already, some places are already fully crypto need, essentially. Obviously, they have US dollars too, but they're fine with crypto. And allowing them to get yield would be amazing for sure.
100%. Yep.
Akash, can you please also share with us some situation in India?
I think it's very well covered, and really the similar kind of use cases or the same kind of regulation structure we are saying, right? It's like the most of the world DeFi stands still in the gray area of how it operates. However, kind of as we said, that if we see borderless solutions, then these borderless products kinds of creates in an accessible solution. And I think that's the beauty of these permissionless system and permissionless nature, that the products or the yield essentially becomes global. It doesn't matter the kind of, the geography or the country you're coming in from. The yield has been distributed because those, at least in its current shape, those market pressure that comes in from the regulator side, that doesn't exist. And that just naturally flows across these different crypto cultures that are existing. So yeah, I think that's pretty much it. We definitely appreciate the building on the open nature of this thing, but then at a point, the guardrails start coming in, because it's not just about whether the technology can enable in, but how you can actually enable in those services in a regulated manner. Let's say, for example, people in the citizens of India or in the Singapore, at least these two jurisdictions where we operate in, it's difficult for a general person to go invest in, kind of make a foreign direct investments or such. Now, regardless of how you bundle it, maybe these products become accessible for the short term, but then kind of it remains a regulatory barrier, that how does that product will operate at a scale if the regulation is not necessarily approving or allowing. So I think that's something to wonder upon, but I believe that we are solving it slowly and steadily. We are solving it.
Awesome. Glad to hear that we're solving it one day at a time. So yeah, the next question. Traditional yield products often require long lockups, whereas DeFi emphasizes liquidity. So how important is liquidity in generating sustainable yield in general?
Yeah, it's a good question, man. We've approached it a few ways, and I think the biggest issue, why you're seeing lockups is really a factor of liquidity, right? If are running with low to no lockups, then managing liquidity becomes much harder because assets aren't very sticky and they move around quite a bit. The other main issue is if you're trying to move tradfi products that have a yield off chain on chain, there's going to be a huge duration mix match, right? Like the off-chain stuff is not built and the structures aren't there to really, do this as a free float token. One of the reasons we chose to do, fixed term, fixed rates is really to make it easier to onboard institutional borrowers with collateral that might have duration. We still acknowledge that people want short duration, high yield. So we, approached it in that manner. There will be some duration, but it's going to be short. It could be, 15 to 90 days or longer. But, we're trying to put out a product that solves these long hold periods, but still makes it easy enough for institutions to come on board. Some folks have approached this by doing free float tokens backed by duration products, and just, I've got some insight into how those are going, and it seems like very difficult to manage, right? And that's not something that really gets fixed easily. I think it can get fixed by some really large parties coming in and managing liquidity, but I don't think those are necessarily like readily available. It's kind of like people are doing it one-off on their own now, or you can choose to do like short-term, low duration stuff like we're doing. But yeah, it's going to be an issue. I think that sort of persists, right? The other people, like there's people solving this, right? So we're talking to a few, I don't know what category you'd put them in, but there are people who are willing to take on duration because they know they're going to get paid. So there are sort of third-party providers who are willing to take higher duration tokens and manage that. And they're basically, in exchange for the future yield, bringing, near-term liquidity to these protocols.
You have anything to add, Akash?
Yeah, I think that's well covered. But for me, kind of seeing that whether a productive asset is locked or highly liquid, it essentially, changes for an asset manager's point of view, it changes the accessibility of strategies that you can use for that particular asset, right? If you have to operate in a constraint that liquidity has to be made available instantly, that means that, of course, you can just explore a handful of strategies in order to put that capital to work. We provide a longer time with it, the longer generally this lockup time frame is. There is more flexibility on how we can put that asset to work in a more strategic way, and this kinds of aligns your capital with your risk and the time horizon, because that matters. Just the time horizon removing itself kind of changes the risk profile or the nature of that asset itself. If you have a liquid, very highly liquid asset, like you put, say, something like on Aave, which of course tries to say that you can always get out your liquidity, but we have seen that kind of, let's say, for the USD, what happened with USD1, right? On some of those stable coins, we saw that even the lending markets, when not operated in a well-designed manner, can fail in a very wrong manner. So while it's false to say that the liquidity is free, but the liquidity got captured inside, right? Because the borrowers have taken out. So I think it just changes that when we have a particular liquidity time frame, then this real capital formation obviously requires a commitment over time. So liquidity is important, but too much instant liquidity can just make this too short term and not that sustainable. So fully agree with Tyler on that.
Yeah, that's the risk with these protocols. I totally agree. It's that you get too many incentives, and it brings maybe bad players that will just take it all.
Tyler, just now you mentioned like DeFi yield. Actually, many people, they complain about unsustainable yields from they play with the DeFi products. So what, in your opinion, actually separates the sustainable yield from the Ponzi or Ponzi-nomics?
Definitely. I'll give some examples. You've heard me touch on them a little bit to date. Every yield that we're putting out through Splyce is completely fixed rate, meaning there will be absolutely no compression. And these yields are being funneled to permissionless users by institutions who are looking to borrow against collateral. And this collateral is often tokenized, RWA assets that have an inherent yield. And then because they want liquidity or they need liquidity to, do a variety of trading behaviors, they're willing to offer, a fixed rate APR to permissionless lenders. So in that way, we'll see absolutely no compression. And with our distribution asset, Splyce USDC, which is pretty much like an aggregate yield product that combines all of our single asset vaults yield, we expect to actually see it operate structurally much different. I mean, you could think of it like Syrup USDC, but Syrup USDC still sees fees compressed based on market activity or market downturns. Ours are fixed rate, but in a market downturn event, institutions are going to be more incentivized to need liquidity. So they're going to be willing to offer higher APRs to lenders. So we actually expect to see our yields go up during stress events, versus what we've seen to date, which is DeFi yields compress.
Wow. Sounds
That's
like a
good.
great product. Wow.
Yeah.
That's
Yeah.
a really great way to package in a product for sure.
I have another question actually. What metrics or signals do you guys personally look for if you wanted to put some of your money in a DeFi product?
We'll let Akash go.
Always changing. I think it's always changing, right? DeFi has been all about chasing in alphas, and the alphas doesn't remain sticky, right? Because most of the time you would see the cycle that some opportunity comes on. And in most cases, those opportunities will be some unsustainable sort of money, kind of the grab incentives opportunity. The retail will move with its speed, kind of get the first dips into it. Then the institutions will come in if something that interests them. And then it's flooded with that much amount of capital that it cannot bear the real use case that we see in DeFi, right? So taking away all the yield with it. So everyone comes on the same fair ground. I think that's how you have to chase alphas in DeFi, right? Getting to where this high unsustainability is coming in from. You can always deposit it into something like Morpho or like Splyce, right? And get in that regular flow of yield. But when it comes to chasing yield, then it becomes a whole different wild west in DeFi.
Yeah, then you end up with Luna.
Yeah, and that's fair.
Man, I made so much money on Luna. You guys have no idea. Oh, man.
Exactly. So someone lost money, someone made money, but everything was strong and aggressive, right? Those who made money was making money in a fast way. The lending protocol is offering 23% yield, and then you put in a few more structured products like the Aperture and whatnot, and you are getting 100% yield on stable coins. Now, what the hell is this, right?
Yeah, how long can you do it, and who's gonna lose on it, right? It's really crazy though, but it's fun. Actually, that cues me perfectly to the next question. Do you think that DeFi has fundamentally changed the risk return curve, or just repackaged it?
I think we are seeing a completely different risk return curve in DeFi. I gave an example of more tradfi distributors packaging DeFi yield for traditional markets, and that's the underlying reason, right? Because in DeFi, you're getting completely unique risk return curves that you simply aren't seeing in traditional finance. For me, that like specific thing is probably the underlying most interesting reason, for institutions to start dabbling in DeFi. It is unique, and it's not something traditional finance has seen before. So it might rhyme, but it's completely unique on that side.
Got it. So it actually is a better risk return curve, and that's what's bringing institutions in the first place.
100% the way I see it. Yeah.
Wow. Akash, you have anything to add?
I think I will extend on Tyler's here is that while definitely these new products or repackaging has happened, I agree that the risk return curve has changed drastically, especially in DeFi. And mainly, I believe, kind of from my personal experience of being in DeFi for over 6, 7, 8 years now, is that it has introduced these new forms of risks that never existed, right? And ETH has been amplifying on that. So you always have market risks, right? Or the counterparty risks that you had in the TradFi or in the worlds before. But now you also have a smart contract risk, you have liquidity risk. And I think one of the biggest thing that people are still, underestimating or seeing is that there is an execution risk as well, right? We have seen, again, kind of taking in the same similar ideas or example from the hyperliquid whale that we talked about, right? These execution risk comes from the fact that many of these positions are, let's say, fully visible in real time, or they can easily be crawled by these MEV bots and know what's the intent with which you are moving and how to front run it, or kind of change the curves around this. And we are seeing that the most of exploits are happening in the similar way, right? Because you see how the risk has been changing or has been layered on protocol by protocol, and on which particular, kind of at the smallest attack vector where it's most softly, you can attack on that and you can take it out. So this helps change the risk reward factors in a very different way, for sure.
Very interesting.
Yeah, dude, Akash, good points, man. Risk return curves definitely different, and I think improved, but there's new types of risk that come in. And frankly, I mean, we've seen it over the past few months. Like, this stuff has to get fixed. Can't see like platform hacks and exploits. Every single day I log on to X if you want institutional money to move into the space, right?
Yeah, in terms of institutions, like institution risks you mentioned, right now prefer like more traditional resources like treasuries or private equity. And what do you think right now is holding them back from fully embracing DeFi? Is that regulation, infrastructure, or trust? And what needs to happen for institutions to allocate significant money on chain?
Yeah, for me, it's two things. It's going to be security, which I just mentioned, and the other one's capital planning. It's hard for an institution to underwrite, a DeFi play if the rates are variable. So fixed rates, is an attempt to solve this type of thing. We can't have contagion risk across the entire ecosystem if one loan blows up. Like, this is not an acceptable solution essentially for a corporate CFO to sign off on. So it has to be something that's a bit more stable and something they can do capital planning around essentially.
Fully agree with Tyler over here. But sure, if in my opinion, if the institutions have to come here and play, then they want, or they favor over everything else, they favor predictability. That what they know today, that what will happen with the capital, let's say 7 days down the line, 30 days down the line, 3 months down the line, 5 years down the line, right? And this predictability matters a lot. Now, when, in the current shape of DeFi with most of the active DeFi, this predictability becomes a problem. Whether it's a volatile interest rates, unpredictability, right? What's the yield I'm gonna get? If it stays highly volatile. Unpredictability in the sense that people see and knows what exactly how much I am borrowing. So my competitors know that what my strategies are, what's I'm lending, what's I'm borrowing. All of this kinds of creates these systematic risks, which takes them away from the prediction, the predictive environment they would want to operate. And this, I feel, is really the missing layer where we can give them more and more predictability of execution, of the flow of capital or the flow of information, in fact, right? That who has the information of those capitals will make them use DeFi more and more for sure.
Yeah, I definitely agree. Yeah, it's definitely risk management. It's a big part of this. I think it cues perfectly to our last question, actually, because, last month there were a lot of hacks, right? There was KelpDAO. There was...
I'm exhausted already, but...
Yeah, 500 million stolen. I mean, it's a lot of money, and most of it went to North Korea. How can we expect the future of DeFi to avoid these risks? And will we just have to accept these realities where some yield products will ultimately just fail, even though we did everything right?
I think I have a very specific opinions towards it. I had seen the similar kind of shifts back in 2018-19 when a lot of smart contract vulnerabilities they started getting found out, right? From the Ethereum DAO hack back in, I think, 16-15, right, many years ago, to a lot of DeFi and the smart contract hacks. Ever since my time in crypto, I have seen that hacks have been prevalent. From 2012 Mt. Gox, right? So it's just that the hack should change in its nature. Earlier, there were a lot of sexes that were getting hacked. Over the time, they built a systematic, strong parameters that kind of helped them that the news of sex hacking got less and less prominent. Last hack we heard was for FTX, and no one wanted to believe that you have got hacked, right? You have stolen the money. That's right out, right? You are just putting a mask for hack on that FTX got hacked. So by that time, if you see, the technology has matured enough to know that, okay, we have this hot wallet, cold wallet, and whatnot concept, so that the sexes wouldn't get hacked. And then the time came in when the smart contract we were able to find these smart contract vulnerabilities. A lot of them, right? Year by year, we have been finding them. And over the years, by finding those vulnerabilities, we strengthened them. Now, we don't see those technical smart contract vulnerabilities a lot. But then we still have those people risk. Now the hackers have moved in that, you cannot just make in a smart contract protocol or the logic because that's been advanced enough. So they have started attacking on this social engineering aspect of it. Because that's the novel part, right? This is the part where still humans have, not adopted themselves at the level that's required to be at least the level the capital is required to be, right? DeFi sees serious amount of money being controlled by immature teams, right? And by immature teams, I don't mean any bad for them. It's just that they would bring in some very highly innovative product that will look very good, right? And people in DeFi are so reckless, they ape into with the millions and billions of dollars. Maybe the developers themselves, they didn't knew, and they, some of those products I have seen that just blew up. Developers were not even confident enough that how much the product will function, but kind of the virality of the product, they just get in more and more towards. So that's DeFi. Something to watch out for.
Yeah, we've got a couple like sort of good examples, I think, recently of where I think it's headed. And, I hope I don't get too much hate for this, but you're going to see things like insurance come into DeFi. You're going to see like what Aave just together with DeFi United come into play much more. They got some flack for that, but at least they did the bailout in like a pretty decentralized way, right? And I think, their plan for the future is to make it even more decentralized, but you're going to need backstops like that for institutions to come into this space. And the example I'll give on the security token side, so like tokenized securities, tokenized funds, every one of those has a clawback feature because it was literally mandated by the SEC. So those tokens, no matter where they go, they have embedded compliance that allows those tokens to be reclaimed or, burned and then reminted, which is, obviously very against what like the core ethos of DeFi's been. But warming up to some things like that is probably what unlocks the next stages of growth, to be honest.
A very good point. Yeah, it seems like it'll be less decentralized, but at least more compliant and safer in a way.
Yeah, no one wants to lose their money, right? Like at the end of the day, you can hate on it from a centralization aspect, but I guarantee you, if you ask someone who just lost 7 figures, that they're going to be like, no, give me the centralized features that give me my money back.
That totally makes sense. Awesome. Thank you guys for coming to the Block and Bell podcast. I think we covered a lot of amazing topics. It's really cool to see what you two guys are building. It definitely will change the DeFi space for the better. I'm really looking forward to seeing you guys in Miami if you're there next week.
We'll be there.
Thanks for joining us. Thank you, guys.
If you enjoyed today's episode, please subscribe, like, comment, and share. And if there are other topics you'd like us to cover in future, please let us know in the comments. We'd love to hear from you. Thank you for watching and listening, and we'll see you next time on Block and Bell.